We're here today with Bill Longbrake, Executive in Residence at the Center for Financial Policy at the University of Maryland. Bill writes a monthly letter called the Longbrake Letter that addresses multiple macroeconomic and policy issues. Every month he and I sit down to speak about some of the issues in his previous letter and also current events. Bill, thanks for joining me today.
Well, it's good to be here, Michelle.
Great. To start out with, I do want to address a debt deal that was passed just earlier this month to raise the debt ceiling, and this included a 10-year discretionary spending cap, as well as a plan to have a so-called super committee to identify an additional $1.5 trillion in deficit reduction by November for the next decade. Do you think that this committee will be able to come into an agreement by the stated November deadline? And if so, what types of cuts might we expect?
Michelle, before I answer that question, let me give a little background. First of all, I'll just make the general comment that the debt ceiling deal was quite a spectacle and one that did not reflect at all well on our politicians, and that's confirmed by polling data that just shows the American public is disgusted, would be a word that I would use with the outcome. And also the content of the program actually is quite disappointing. But let me explain. It's officially known as the Budget Control Act.
Okay.
And it has 4 components, and you mentioned a couple of them, but to put this in its fullest context, I want to take a moment just to explain all 4 components. So the first component actually is the debt ceiling increase, which was the whole point of the deal, of the August 2nd deadline to get that done, and that we did avert default. That's a good thing. But the debt ceiling increase occurs in 3 waves. The first one was immediate and was $400 billion, so that takes us through the next couple of months. The next one, the president gets to request $500 billion, and that will take effect automatically unless both houses of Congress pass a joint resolution of disapproval. But then the president could veto it in any event if they did, and it would require 2/3 majority. So that's a bit of a charade. It's going to happen.
Right.
And but stay tuned, because there will be some around about September, October, some discussion about that. And then the third part is a 1.2 trillion to 1.5 trillion increase in the debt ceiling, but that will depend upon 2 other things. It will depend on this joint committee that you mentioned as to what they come back with, or whether Congress passes a balanced budget amendment. All right, and we'll get to that in a moment. So the second part of the Budget Control Act is discretionary spending caps. And the discretionary spending caps will kick in immediately, and they're over a 10-year period. And about 55% of them are focused on non-security aspects of the budget, and 45% on security, which really means the defense budget. All right, and those are they're discretionary, but they're supposed to be automatic, and that amounts to $920 billion when you include interest savings. All right, so now keep in mind the target was 2.4 trillion. We've got 900, we have to come up with the rest. And the rest then goes to this joint committee that you mentioned, and there's actually a range that's been specified. That range is 1.2 trillion to 1.5. And the committee has to get to at least 1.2 trillion in recommendations, or if they don't, then automatic spending cuts will kick in at the beginning of calendar year 2013. Does this sound a little complicated to you? All right, but the...
and what is the likelihood that that'll happen?
Well, the likelihood is not very high. I'll get to that moment, but the 1.2 trillion minimum that's required, if that's not reached, then there are automatic spending across the board cuts that will kick in beginning in 2013, and to get to the arrangement. Now, you say, well, what's the likelihood of getting a deal? Well, you've got 12 members on this committee, 3 from each of the parties, both House and Senate. As of this moment, about 9 of them have been selected. I'm sure by the time the video airs, all 12 will be there. But the composition of those selected so far are party leadership. And you've got people like, on the Republican side, Jeb Henslerling, who's out of the House. He's part of the Republican leadership in the House. He is the most conservative membership of the Republican leadership. He is on record as being opposed to any kind of tax increase whatsoever.
So you have some extremes in this committee.
You have some extremes. And then on the Senate side, you have Patty Murray, Senator Murray from my state of Washington. And she is part of the Democratic leadership. In fact, she chairs the Democratic Senate Leadership Campaign Committee. And the Democrats have been quite adamant about we will not touch Medicare or Social Security. Now, I can just tell you, Michelle, that you cannot get to 1.2 trillion in additional spending cuts. Remember, we already got 900 that's on the table, without getting into entitlement programs and tax reform. Really, it's both, and I don't think either of those are going to be in play to any great extent, so it's hard to see how you even get to 1.2 trillion. So the bottom line is it's not very optimistic. Well, what happens if they don't? Well, what happens, again, as I said a moment ago, is you have these automatic cutbacks kick in at the beginning of 2013, which is conveniently just after the presidential election. So we will see what happens, but I'm not particularly optimistic. If they, by some chance, this committee does get to a recommendation that hits at least 1.2 trillion, and it could be as high as 1.5, that's the objective, but then if they do, it's an up or down vote in both houses, simple majority, not subject to amendment.
Wow.
So that part probably is a good part, but having these 12 people get together to have a compromise just seems improbable at this point in time. Now, what could change that? What could change it would be financial turmoil in the marketplace. It's a long time between now and November 23rd, which is when their report is due to Congress. And we could have a lot of pressure that develops to change political attitudes. But based on what happened leading up to August the 2nd, there's no reason I see for optimism.
Okay, well, thank you for being honest. Now, if these automatic spending cuts come into place, what will be affected? Will it be everything across the board? Will it be particular programs?
Well, the automatic spending cuts, and that assumes failure of the Joint Commission of 12. And by the way, there's also a balanced budget amendment. If the balanced budget amendment is passed by both houses, then the 1.2 trillion automatic cuts is off the table. That's it. But then we'll see if that might happen. It might not. I wouldn't care to predict the outcome on that one at this point.
Okay.
But the automatic spending cuts come equally out of defense and other programs, with the exception that Social Security, certain low-income programs are exempted, and Medicare can only be cut by a maximum of 2%.
Wow.
So again, that means that the rest of it has to come out of what remains.
Right, absolutely.
Which is a much smaller
pot. Yep. Okay, thank you so much. So Bill, you spoke about possible turmoil in the financial markets, and I'd like to address that because over the past few days we've seen some pretty considerable market volatility, having significant gains one day followed by pretty significant losses the next day, and it just seems to be this pattern that we've seen over at least the last few days. What are we to expect in the short and long terms?
Michelle, you are the master of understatement. Considerable volatility. You have to go back to the fall of 2008 to find anything comparable. And these kinds of I call them wild gyrations, are indicative of a panic environment, one that's fraught with enormous amounts of emotion. And it's caused because investors really are quite uncertain about what's going on and what's going to happen, but they don't feel good about the prospects. And so part of what the market is searching for is to figure out, well, what is it exactly? What are the risks? Is the direction of things? How bad is it going to be? But to begin to probe the answer to that, you have to look back and say, well, what was it that suddenly unhinged the market? Why out of the blue did it go from being pretty steady for a very long period of time, and suddenly it just became enormously volatile? And you could say, well, Standard & Poor downgraded the U.S. debt because that was approximately the time period in which the volatility began, but it's much more complicated than that. There really are two sets of things that are going on. They're different, but they're running in parallel and they're having similar impacts on the market. The first has to do with the European debt situation. I've talked about that in letters. We've talked about that in previous videos. And we can talk more about that in a moment here in greater detail. But essentially, the solution that was made for Greece was fine for Greece, but it didn't solve the problem. And indeed, the concerns have switched to a much broader base throughout Europe at this point. And quite frankly, part of the concern that's entered into the picture is a slowing of global growth and a worry that you will have a conjunction of two things that will have a negative outcome. The conjunction would be fiscal austerity, which is intended to get sovereign debt levels down, with slower growth or even recession. And those two things in combination are a toxic mix because they tend to be reinforcing to the downside. Right. All right. Then the other part of this has to do with the United States, and it's sort of a similar kind of problem. It's not a sovereign debt problem, but it is I guess it is a sovereign debt problem when you talk about the U.S. fiscal situation and needing to curtail the debt. And also at this same point, the GDP numbers came in much reduced, and it suddenly looks like there's very little growth, and maybe even there's a recession around the corner. And that's what the market's going through, is an enormous amount of uncertainty, but also the news is not positive. So my outlook, more volatility. The emotional bottom has not yet been found. And some days will feel really good because the market will go up 3, 4, 5%, and other days it will go down by a similar amount. Eventually it'll play itself out. How? I think we have further to go on the downside on that basis. How far remains to be seen.
So if we could switch over a bit to monetary policy issues right now. Earlier this week, Ben Bernanke announced that the Fed would keep interest rates near 0% until at least mid-2013 due to an outlook for an even slower economic recovery, which you just spoke about. He also mentioned that the Fed has a range of policy tools that it's prepared to employ. What types of tools is he referencing? Are we likely to see another round of quantitative easing? And if so, at which point in time will he utilize these tools?
Well, let's, again, I'm going to answer that question, but in a roundabout kind of way. Let me begin by saying that monetary policy really has got to the point where it probably has limited ability to have any substantive impact on the economy. And that's because monetary policy works through the interest rate mechanism by reducing the cost of credit. And at the moment, the credit system in many respects is broken, which is to say it doesn't matter how low the interest rate goes. People still won't borrow or people won't lend. So that's part of the Fed's problem, is what can they do? And the tools that they have left really are more aimed at inspiring confidence in the market than it is actually in changing the demand for credit. So the tools that they have, again, very limited number of tools, but the first tool they actually did invoke, which is to be more specific about the time frame where they're going to keep an accommodative monetary policy, mid-2013. And indeed, in the immediate aftermath of that, the long-term Treasury rates traded down by 15 to 20 basis points. So you did get an immediate benefit by flattening out the yield curve. In a similar way, the Fed could, as the principal matures on the quantitative easing that they've already done, they've already committed to reinvest it. they could reinvest it in longer maturities. Why would they do that? They would do that, again, to flatten out the yield curve. Right now, everything out to 2 years, because of this extended, we're not going to raise rates for 2 years, you can get a 2-year treasury at under 20 basis points in yields. So there's not much further that you can do there. But if they reinvested in, let's say, 10-year, and took it out of 2-year, it's called Operation Twist. You're flattening out the longer end of the yield curve, and that would hopefully bring down mortgage rates and things like that, that are longer maturities. They could also reduce the interest rate that they pay on excess reserves. And it has to be on the list because it is an option, but they only pay 25 basis points now. And they could reduce it to 0, I suppose, but it's unlikely that would have a very large impact. And of course, then that leaves you with the question you asked: what about the third round of quantitative easing, build up the balance sheet even more? Looking back on quantitative easing, you could say there's been 2 rounds, and we are where we are, and what good has it done? And you could even be more negative and say, what bad has it done? And on that side of the equation, the quantitative easing, and Chairman Bernanke said it himself back when the program was first introduced, the second round last December, that part of the intent was to push up the value of risk assets, namely stocks. And it did do that for a period of time. Absolutely. All right? And the whole notion behind doing that is that people feel wealthier and they spend out of wealth, and somehow that will help kickstart the economy. And it did have that impact for a period of time, but now as we're witnessing with the market volatility and the downturn, it was a temporary phenomenon. And so the question has to be raised, was that really effective in a long-term way of getting the economy going again? It doesn't appear that's the case. So you could do quantitative easing, and the financial markets certainly want it, because right now, with all the turmoil and the negativism, if the Fed would simply announce doing that, I do think it would change the emotion in the market, and it would be a positive from that standpoint. But whether it would have any long-term benefit is another matter.
So let's talk a little bit more about economic recovery, or lack thereof. The latest jobs report showed little sign of economic recovery, in my opinion. 117,000 jobs were added, which was a slight increase over June's figures. However, while the unemployment rate dropped to 9.1%, we saw that as mostly because of a 14% increase in discouraged workers exiting the labor force and not being counted. In addition, the average duration of unemployment rose to 40.4 weeks. Does this further highlight a need for policymakers to redirect resources away from stimulating consumer spending and really fostering investments to try to stimulate long-term job growth? Does it send us any other messages?
Well, the short answer is yes, but let's probe that a bit. This country needs about 100,000 new jobs per month just to keep pace with the growth in the population and in the natural growth in the workforce. And if you don't get that, then the unemployment rate's going to go up. So 117,000 and the unemployment rate dipping a little bit wasn't a material difference. It's essentially a very weak report. What the problem is, and I discussed this in the July Longbrake letter in considerable detail, is that the policies that we've been pursuing, which are so-called demand stimulus policies, in other words, put money in people's pockets so that they can spend it, and then as they spend it, it will somehow lead to job creation, that hasn't been working. And the alternative that could have been pursued but has not been pursued would be actually direct programs to create jobs. How do you do that? Well, it would be through things as simple as supporting education, research and development, infrastructure building, and these are things that economists talk about and policy people have talked about, but really there has been no significant groundswell to do that. The problem now is, and this goes back to our discussion about the debt ceiling and the cut to the deficit, right, is we're out of room. because job creation programs do require investment. They will require spending. Yes, you could do it in a way that it would involve public-private partnerships so that you would get the private sector participating, but the government has to be the catalytic agent for that to really work. They have to take the leadership. The focus is not there politically right now, and the resources are not available. So I'm not very optimistic about the ability to focus on job creation. I want to focus, again, this was in my July letter, that there's some research out there that hasn't got a lot of notice yet, but it's well done. It focuses on where does job creation come from? And the findings of the research are that the vast preponderance of all new jobs created on a net basis come from new startups, firms in their first 5 years of existence. So this would be innovation, entrepreneurialism, and so forth. What the evidence shows when you look at the data, Michelle, is that the number of new startups has dropped precipitously by about 30% over the last several years. So we're not creating the new businesses that create the new jobs. Now then the next question would be, well, why isn't that happening? Well, there are a variety of reasons. Probably the most obvious one is that given the financial problems that we've had since 2008, it's hard to get loans. Your home equity, which used to be a good source of credit for a budding entrepreneur, it isn't there.
Right.
It might be you're underwater worried, but you're not going to get any financing from that. So access to financing is a major problem. But I would say it goes beyond that. Again, it goes back to a lack of systematic support out of our institutions, and this again goes to government, of job training, education. If you want to be an entrepreneur, how do you avoid making mistakes, things of that sort. What access to resources do you have? But there's been no systematic effort to do that. You could add to that, many people do uncertainty. Are you going to go into business when it's not clear that we're in an environment that's going to be successful? The risks are much elevated. Regulations have been actually increasing. So the environment is quite hostile, actually, to new business formation. If we wanted to get the jobs going again, I would call this would be rebuilding America, not by just plowing money in and hoping that somehow it will magically create jobs, but actually intentionally focus on how do you create the jobs on a more direct basis. That would require a lot of effort, it would take resources, and it would take a long time for it to actually materialize, but I don't see a better alternative.
Right. And unfortunately, right now, we are lacking resources, and I think most people are looking for something, anything that will give some short-term benefits.
Well, that's unfortunately, that's our society, is we are hooked on the quick fix, and the quick fixes are not working.
Right, and they're not going to work to solve this problem.
No.
You mentioned a little bit earlier about the European sovereign debt crisis. There has been a bailout plan that's been implemented for Greece, but let's talk a little bit more about Europe as a whole. Since we last spoke in July, again, the EU leaders agreed to a 109 billion euro assistance plan for Greece. In addition, the ECB has begun to buy Italian and Spanish government bonds to stabilize borrowing costs. What are your thoughts about these actions? Are they strategies that will work in the long term? Are they just temporizing strategies that kick the can down the road? How do you think that the European leaders should address the underlying problems of the stalled economic growth in addition to this excess debt?
They are temporizing solutions. They are kick the can down the road solutions. We have yet to get to a serious set of solutions that will actually put in place a permanent fix. But let's review again what's happened. Events have just unfolded at a very rapid pace. It was less than a month ago that Greece was seemingly on the edge. It's now not even in the newspapers any longer. It's been overtaken by events, and that's because, as you said, the solution that the Europeans came up for Greece, the 109 billion euros, actually keeps Greece out of financial markets for 2 years. They don't have to go back to the markets to raise debt. They're taken care of. And so it doesn't matter what happens to Greece at this point. They're out of the picture. But the solution itself actually sowed the seeds of the next phase. Because part of the problem here that we've been talking about right along is when you have too much debt, which Greece obviously did, and you can no longer finance it, or you can only finance it at interest rates that simply drive the debt higher, you ultimately have a solvency issue, and that means somebody's got to take a loss. And so that was part of the solution on Greece, was who takes the loss. And part of the loss was actually pushed back on bondholders. And that was done in an indirect way by rescheduling the debt. So here I have a piece of 2-year Greek debt. Now I'm going to take a 30-year bond
Right.
at a reduced rate of interest. And anybody that has taken a basic course in finance knows the present value of that means you have something that's less valuable. You've undertaken a loss, you've
Right.
absorbed a loss. That was not lost on investors, all right? And almost as soon as the ink was dry on that agreement, the speculators started attacking Italian debt. Now, why Italian debt? Well, because Italy has got a pretty dysfunctional government right now. It has a very high public debt to GDP ratio, and it has almost no growth. And so it becomes sort of, well, if there's a next domino to fall, it would be a likely candidate. So let's get out of Italian debt. And that's what speculators started doing, and the interest rate on Italian debt crept up, and it crept up, and it crept up, and it crept up. Got to the point where it looked like there could easily be within days a financial market riot that would create an untenable situation for Italy. So the ECB came in and did what Jean-Claude Trichet said he would never do, but now they're doing it, is they're buying Italian and Spanish debt. Well, the immediate effect of that was to drop the interest rates from over 6% to around 5%, which I might add, to 5% still is more than 200 basis points above German funds. Okay, so yes, it reduced the rate, but it certainly didn't put them in the same class as a AAA credit. That's part of the problem, is that now the Europeans, just like in the US, are going through this reassessment of, well, where does the economy go? And it looks like it's going to be slower growth, maybe even recession. Certainly that's the case for Italy, probably as well for Spain, maybe even some of the other European countries as well. And as I said earlier, whenever you have cutbacks on government spending with the attempt to reduce the debt, and you have a downturn in the economy, that is a toxic mix that doesn't work particularly well. Because you may reduce the debt, but if you reduce the GDP faster, you haven't changed the debt load, and maybe it even gets worse. That's what happened in Greece. It could happen in Italy. Well, who holds those Italian and Spanish bonds? Well, mostly European financial institutions. And so we've, in the last few days, seen yet the next leg of this, which is a liquidity crisis for other European financial institutions, in particular French banks, and among French banks, Societe Generale has been the focus of attention. And the reason for that is, if indeed there is a haircut of the sort that occurred in Greece, guess who it hits? And at some point you have to say, well, is there a solvency issue? Is there enough capital? And remember back to 2008 in the United States when we solved this solvency problem by passing TARP. Now, TARP was a matter of socializing all the debt, bank debt, and it was successful, at least for a period of time. We're now in a period of testing to see again whether that's the case. But in the case of Europe, now I'm going to get to your question. Where does this go? What should European policymakers do? First of all, temporizing kicking the can down the road just extends out the problem. It will get worse, it will come back, it will have another episode. We've seen this on a sequential basis. Where it ends, I'm not sure. One place it could end would be to have a physical union similar to what exists in the United States. But that would mean each of the members of the European Union giving up their sovereignty, all right, over a great deal of things. And the question is, can you get from here to there? But if you had a fiscal union, then you would have the collective support of the entire 17 member nation economy. Issue Euro bonds, you replace the Spanish debt and the Italian debt with the Euro bonds.
Right.
And it becomes the obligations of all of them collectively rather than the individual countries. The alternative, if you can't get from here to there, is that you continue to stumble along, you continue to have half measures, you try to contain. Again, I'm not optimistic that that produces good results in the long run because it will depress economic activity and become self-defeating in that sense. The other alternative is what we call, fancy word, devolution, or a busting up, to put it a little bit more graphically, of the European Union and going back to nation states.
Are any of these alternatives more likely than another?
I don't know. I mean, this is one of those things where it depends on politicians and what they do, but it also depends on the public sentiment in the individual countries, and particularly in Germany, which is the strongest economy and the linchpin of the European Union.
Absolutely. Okay. Well, I'm sure we're going to revisit this.
I am sure we will.
Well, that wraps up my questions for the day. Thanks again, as always, for joining me here.
I'll look forward to next month.
Me too.